With the increase in density and land developments in Sydney, some people are fortunate enough to have their properties rezoned from their existing residential living zones to a much higher density that attract the interest of developers. While this creates huge opportunities, owners should also consider the tax implications of selling the property to a developer. For instance, if the sale as a principal place of residence is classified as an ordinary sale, it should not attract profit tax. Sales of land or residentials deemed to be a profit transaction will attract significant tax liability. Let's consider some examples. If the principal place of residence is on 5 acres, has always been used as your principal place of residence, it can be classified as an ordinary sale to anyone, including someone who may consider redeveloping the land, as long as the contract is prepared properly. There can be nothing in the contract that will give rise to classifying the seller as a developer or classifying the transaction as a transaction for profit. It should simply be a realisation sale of your principal place of residence or the sale of a capital item. An ordinary sale should not attract profit tax, but again, careful consideration must be given to ensure this does not occur. If a person lives on 5 acres that has been rezoned residential and wants to sell to a developer, while still retaining their house or principal place of residence, this transaction is fraught with danger. In this instance, unless the contract is properly prepared, the residue sale of the land to developer may be classified as a sale of land rather than the sale of your principal place of residence and will attract additional tax. In such circumstances, it can be better to sell the whole 5 acres to the developer and look to buy a principal place of residence somewhere else, or to sell the whole 5 acres and then enter into a contract to buy back the principal place of residence. While this would usually involve payment of stamp duty to buy back your residence, under normal circumstances it will avoid the tax on the sale to the developer as long as a contract has been properly prepared. If you wish to sell the whole 5 acres and purchase the house back, you should ensure that the full purchase price is paid for at the time of sale, and then a subsequent payment to purchase the principal place of residence is made at the time of the repurchase. This means that if anything was to happen between the sale of your land and the purchase of your principal place of residence, you are legally protected and will have access to proper compensation. It is also worth noting that the New South Wales Government is currently considering whether there should be a tax on land that is rezoned, and upon the payment made to the government for the component of the financial gain received by the seller. Again, careful consideration should be given to the possibility of this tax being introduced in the future before you enter into any transactions. While selling your principal place of residence to a developer does, in most circumstances, result in a large financial gain and uplift, you should ensure the transaction is properly prepared, implemented properly to avoid any tax consequences. The key is seeking professional advice from an accountant and an experienced property lawyer to ensure you understand and avoid all the possible pitfalls. If you require any further information on the sale of this nature, please do not hesitate to contact McLaren's Lawyers.